Good day, traders. It's Letumtembu speaking, the founder and mentor at Blue Million Forex. So today is quite a very interesting and exciting topic, and I feel like it's one of the for me the most second underrated topics when it comes to trading. Number one for me is trading psychology, which a lot of people tend to overlook and not really pay attention to. But in today's lesson, we are going to be speaking about advanced forex trading strategies, basically risk management strategies for advanced traders. So, if you are if you already watched the previous videos that were sent out, you will get to understand as we move on into this topic. So if you haven't watched them, please make sure that you go watch them. They've been sent through emails. And just make sure that you watch them so that you can catch up and understand, because this is a bit more advanced. Like I said right here, it's a bit more advanced, and you need to understand certain things so that you can better understand the whole topic. So, without any further ado, let's get into it. So, this will be module one for risk management strategies for advanced traders. So, in this module, we'll cover the first thing, which is the importance of risk management in forex trading. We are then going to speak about advanced risk management techniques such as position sizing, stop loss adjustments, and portfolio diversification. Now, this is the interesting part, right? But we're going to speak about it later. It's a game changing thing. It is the holy grail in forex trading. When I speak about the holy grail, I speak about portfolio diversification. If you want to be a winning trader like I am, a lot of people always wonder, Letu, how are you so good when it comes to take profits and stop losses and all those things? It takes time. I failed so many times, right? And I purely believe that you watching this right now can also become a good trader, because it takes practice, it takes dedication and discipline. So, and the last one is real world examples of how risk management can protect a trader's capital during volatile market conditions. So, the first thing is you need to understand what are we speaking about when we speak about risk management. Now, the definition of risk management in forex, it speaks about the set of strategies and techniques that traders use to minimize the potential losses in their forex trading activities. Now, the forex market is known for its volatility, as you guys know, right? Prices can change in an instant, right? Take NFP for an example, right? So if you have an effective risk management plan, this is very crucial for traders who want to protect their capital and navigate the uncertainties of the market. Now, what I always tell people is that your job as a trader is quite very simple, right? Your job as a trader um, is to manage, right? It's to manage risk. That is your job for any trader, right? You need to manage risk. Now, people who trade without stop losses, right? I once saw a video online about a guy who said he doesn't put stop losses in his trades because he believes that market makers, they go and they hit his stop losses and whatever. Granted, that does happen, right? But usually it's an order block of stop losses, not specifically yours. But the thing with stop losses is they protect you to fight another day. For example, I want you to think if you were living in the medieval times and you were a Viking, right, or a shieldswoman or whatever it is, right, and you went to war, right? You went to war without a shield, right? You went to war without a sword, right, and a shield, right? That's the best example I can provide for you. Don't mind my drawing, right? This is a shield, and this is a sword, and this is a shield, right? If you lived in the medieval times and you went to a war against your opposition, and you didn't have something to defend yourself and attack, right, the other party, you are bound to die quickly, right? Because you can't be on the defensive side, neither you be on the offensive side. So you are easily killable, just to put it in high in like in short, right? So people who trade without stop losses, this is bound to happen. Like a person who goes to war without a shield and a sword, you are gonna die very easily. It's gonna be so easy to kill you. It's gonna be so easy to blow your account because you don't have the proper channels or the proper system to keep you in the game for a long time. Now, we're gonna speak about that on a later stage. Now, what do we speak about in risk management? Now, people think that risk management is nothing but stop losses and take profits. It's more than that. It's quite very much deeper than that. So, the first one is position sizing, right? Now, when it comes to position sizing, we are speaking about the lot sizes that you put into your trades, right? So, for each time, you're going to determine the size of each trade based on a percentage of your total trading capital. Now, avoid risking too much on a single trade, as this can lead to significant losses, right? Now, this is something very important. Now, we're going to jump onto a website which helps you to calculate your risk. Okay, now as soon as okay, so what you need to do for this tool is you need to go to the Baby Pubs website and you go onto tools, and then you come here, you click on the tool where it speaks about position size calculate. Now, before every trade you enter, you need to come to this website and determine how much money you are willing to risk. Now, for example, you can pick and choose. Unfortunately, we don't have the rand, but you can use the USD as your currency, right? So it asks you what your account balance is. So I'm just going to make an example, just saying $1,000. Now, for every trade, you are willing to risk 1%, right? 1% for every trade you are going to take. Now, usually when I send signals to the signals group, our stop losses range from anything from 30 pips to 45 pips, depending on the currency pair and its average daily swings, right? So I factor into how much does the currency pair move per day so that I can determine the stop losses. But let's just stick to 30 pips, right? Now, after clicking the 30 pips, excuse me for that. After clicking the 30 pips, you will then click on the currency pair you are currently trading. So in this instance, we are just going to stick to Euro USD, right? So we are going to go down and click here where it says calculate. Now, what this has done is that it told you that since you have $1,000 and you're willing to risk 1%, now 1% of $1,000 is $10. Now, if the trade goes against you, you will lose 10 USD. Now, if it goes into your direction, right? For us, people who take high probability trades, right? You will gain 3x this, meaning that you will gain $30 more. Now, that's what position sizing is. Now, as you go down, it tells you that if you're using a standard account, the lot size you will enter is 0.03. Don't mind the other two decimals, right? So this will be your lot size if you're using a standard account. If this is a mini account, again, if this is a micro account, you will use these lot sizes. And it's just how easily it is to determine the risk to reward. A good trader enters a trade knowing how much they'll lose and how much money they'll gain. That also helps with your trading psychology, that whenever you log into the market, nothing surprises you. Either you're winning or you're losing. You already know how much money you're going to lose, which is 10 USD, right? And how much money you're going to gain. Okay, so moving on, we go on to stop loss orders. Now, this is just basically your stop loss where you set predefined levels at which your trades will automatically close. Right, I understand. But we want to speak about how adjusting this will help you to become a more profitable trader. Now, diversification is spreading your investment across different currency pairs to reduce the impact of a poor performing asset. Now, this is what I speak about when I speak about the holy grail in trading. It's not a strategy, it's not the Bluminant Forex profit manipulator, which also uses this. It's integrated into its algorithm to diversify the portfolio, but we'll speak about that in a later um, um, stage. Following that is risk to reward. Now, a positive risk to reward is always one is to two or one is to three, meaning that you are risking $1 to gain $3, right? Now, this helps you to assess the potential reward for a trade and also putting into account the risk of losing the trade. Now, following that, we are going to speak about leverage. Now, leverage is one thing that's killing a lot of traders, right? I once watched an interview of a well-defined trader or a successful trader who said his leverage is nothing but 1 is to 50. That's what his leverage is, 1 is to 50, right? And this is already a lot, right? If you put into perspective, if you want to move a 50 a 50 just to put it into simple terms, because I don't have a calculator on my hand, excuse me, but it just merely means that you can control 50x. You can control 50 times what's bigger than your account balance, right? Now, what is said in the forex game is that leverage is a double-edged sword. So it's something that looks like this, right? Again, don't mind my drawing. I know I draw very ugly things, but just to put it into perspective, right? It's a double-edged sword. It's sharp on both sides. So as much as it's increasing your potential to high winnings, it also increases your potential to high losses. So with the leverage, be very careful, right? But if you have a good strategy, right? If you have a good system running for you, yes, you can use a leverage of 1 to 500. But if you're a beginner trader and you know nothing and you don't have mentorship under the Bluminant Forex or whoever is giving you mentorship, I'd advise that you use something way less so that you are more in the game and you are long there and you don't just blow accounts for the fun of blowing accounts. Now, moving forward, we're going to speak about monitoring market conditions. Now, you need to stay informed. You need to understand, for example, if you have open trades on USD that if the president of the United States dies tomorrow, right? Any geopolitical event, any event that can shake the US dollar, you need to be up to date. That's why I always tell my students that you need to have the Bloomberg app on your phone and always set it to high volatility news that affect the dollar or whatever currency you currently have open positions for so that you stay informed. God forbid the president dies and you have an open buy position on USD and then it crashes like it crashed during the 2020 pandemic and then you blow your account, right? For a person who doesn't have a stop loss, you blow your account. But if you practice proper risk management, you are protected against all of these things, right? Now, you need to adjust your strategy. I mean, your risk management strategy based on the forever changing markets. Now, another thing is continuously review your trading plan, right? A trading plan is nothing merely but a roadmap for you. For example, just to quickly explain it for you. For example, if you have $100, right? If you have $100 and your trading plan says that since you have maybe you have the Bluminant Forex profit manipulator, which is guaranteed tested over 5 years, right? 5 years back testing, using data from the past 5 years, it's guaranteed 84% win rate, right? Now, if you have $100 and your trading plan is that in the first 4 trades that I win in a row, I'm going to raise my lot size, right? Maybe from 0.06 to 0.10. That's a trading plan. It just basically explains that if you win 4 times, and or maybe your account is up from $100 to maybe, for example, $126, you are going to raise your lot size to 0.10. That's just what a trading plan is. It's basically a roadmap that tells you that if you reach this destination, meaning that from $100 to $126, you raise your lot size. If you lose, you decrease, so on and so forth. That's what a trading plan is, just in essence, right? But I'm gonna make a different separate video speaking about what a trading plan is and why it's important, excuse me, to journal, right? And I hope for people who are listening to this and watching this, you are journaling it somewhere. You are writing this. You are writing what I'm saying down somewhere, somehow. Now, moving on, we're going to speak about emotional discipline. Again, if you have buried some loved one, or you're going through a breakup, God forbid, or you're going through some challenges, I'd say to you, try and trade very reasonably, right? If you used to think twice before you enter a trade, if you're going through something, think 4 times. You need to think very delicately before you execute trades. You don't want to trade with your emotions, right? You don't want to chase the market, right? Because two things kill a good trader, right? What I always speak about. What are the two things that always kill a good trader? Fear and greed. Fear of entering the market and seeing the trade win, and greed of letting your profits run for a long time until until the market reverses and it takes everything back. Now you need to stick to your risk management plan even when you are faced with losses. But we're going to speak about the power of that um, in just a few seconds, right? Now, this is the example that I'm speaking about, the Premium Forex risk management example. Now we're going to jump onto the PDF, just to explain to you how powerful risk management is. Okay, so this is an example that I'm going to provide to you. So we're going to call this person, excuse me, we're going to call this person, let's say, um, trader A, right? For the sake of this video, we're going to call this guy or girl trader A. Now, trader A is risking 10% per trade. Get that in your mind. He's risking 10% per trade. So for him to blow the total account, he only needs to trade only a few times. Now, what do I mean by that? Now, if you look closely, the risk, okay, so let me speak about the losses. You are going to face losses. You need to accept that and understand that, right? You want to there's a time I faced 7 losses in a row. 7 losses in a row, right? You can. It's possible. Days aren't the same. Just as much as you can. I've had a streak win of 12 profits in a week, right? With no loss. It's the forex game. It's the market game. You can win, but you can also lose. Now, look at this, right? This is a very nice example, right? So let's say, for example, trader A starts with 10,000 rand in his account, and he risks $1,000, 1,000 rand per trade. Now the first loss, he loses 1,000 rand, right? Boom, this is gone, right? Now he's down to 9,000. Now 10% of 9,000 is 900. Boom, second loss in a row. Now you're stressing. Now you're only left with 8,000. 8,000, 10% of that is 800, it's 810. Boom, you down again, right? Can you see how much from 10,000 you now to 8,000 within 2 trades, right? It goes on, you're down to 7,000, 6,000. Now this is where things get very funny. Now you're down to 5,104. Now 10% of 5,000 is 590. Boom, you are down again. Now you are trading 5,314. Boom, you are down again. Can you see where I'm going with this, right? 4,000. Boom, you now, your balance is 4,782 within 8 series of losses, right? The total equity drawdown is 5,217. To put it into percentages, you have lost 52.17% of your total account. If you traded for any hedge fund, if you traded for my hedge fund, If I had one, I would immediately fire you because you've lost investors' money, 52% of investors' money, right? Why? Because you're risking so much, right? You're risking so high. Now, this is trader A. Now, let's go on to trader B, right? So, this is trader B. Now, trader B risks 5%, which is still a big amount. Now, again, he starts with 10,000. Now, I'm just going to type here trader B. You want to call this person trader B. And where is this thing? You want to call this guy trader B, and trader B risks 5% per trade. Now 5% of 10,000 is 500 bucks. Now if he lost that, he will be down to 9,500, right? Boom, this is done, right? Already down to 9.5. 5% is lost. It goes on. Now you're down to 9,025. You lose again. This is a third loss. Again, I guarantee you can face a series of losses. You need to accept it, right? Boom, it goes down again. You now down to 8,000 within three trades. Boom, you're down to 8.1, 7.1, 7.3, and then now you're down to 6,000. Now it's not as bad as trader A, but you have lost a total of 3,016 rand and 63 cents. To put into percentage, you have lost 30.17% of investors' money. Again, if you traded for my hedge fund, I would have fired you because you have lost 30% of investors' money. That is still big. Now, what you may be wondering, okay, if I want to be a good trader, what do I do? Right? I want to trade profitably. Now, what do I need to encompass in my trading strategy? Now, let's say for instance we have trader A. Now, trader C, excuse me. Trader C. Now, trader C is a bit better, right? Trader C is a bit better. Not really a bad guy, but he's a bit better. He's risking 2% per trade. Now, let's say she's a she. She's risking 2% per trade. Now, 2% of 10,000 is 200. Now, if you faced the loss, you would have lost 200. Now you're down to 9.8. Another loss. Now you're down to 9.6. Another loss. Now you are down to 9.4. Another loss, 9.2. You get the picture, and so on and so forth. Right? Now, how much did you lose? The total drawdown on equity is 1,318 rand and 75 cents. To put it into perspective of percentage, you have lost 13.19%. Now, if I was a hedge fund manager, would I fire you? No. But would I consider it? Most definitely, right? I would. Because what we're looking for in a hedge fund is to make money. That's our sole job, is to make money. Now we go on to trader C, right? Who's a bit smarter. Now, what is trader C doing? Now, trader C is a very smart trader. Now, what do I mean when I say he's a very smart trader? Now, look at this. Now, this is what people tend to overlook and miss. Now, he's risking 2%, right? But he's the smarter, right? Smarter trader C. Smarter trader C, right? Now he's risking 2% of 10,000, right? And he loses 200. Boom. Now she's down to 9,800. Now she lowers her risk from 2% to 1%. Now 1% of 9.8 is 98 rand. Boom, you only lose 98 rand. Now she lowered the risk from 2% after one loss to 1%. Why? Because you need to adapt. Remember what we spoke about on the slides. You need to adapt to the market, and you need to understand whenever the market is not giving you what it's supposed to give you or what you're expecting, you need to adhere to the market. Right? Don't try and fight the market. It's a very big market. You are literally fighting something that you cannot overcome. Right? Now again, lose 1%, 48. Right? Lose again. Now you're just losing 48 rand for every trade, right? Just losing 48 rand. Again, we are all using the same 10,000 rand. Now, after a long while, smart trader C has lost only 538 rand and 14 cents. Put it into perspective, lost 5.38%, which is very normal, right? Which is very normal. You only need three profits to cover this whole loss. Very attainable, achievable. Now, what would I do to smarter trader C? Nothing. He's a good trader. She's a good trader, excuse me. A very good one at that. Right? Now, this is the difference what I speak about. This is what I speak about. Now, which trader would you want to be? We all started with 10,000. Now, if you're risking too much, you would have lost 5,000, 52% of your account, right? If you were trader B, you would have lost 3,000, 30% of your account. Remember, we are all using the same 10,000 rand, right? Trader C, 10,000 again, but you would have lost only 1,000 rand. We're going down to smart trader C, you only lost 500 bucks. Now, this is the difference between smart traders, winning traders, profitable traders, traders like us who know that the market is ever evolving and you cannot control it. You can't. You can't predict exactly what's going to happen. Like Mark Douglas said in his book of trading psychology, trading in the zone, excuse me, speaking about trading psychology, he said rule number 5, fundamental rules number 5 is that every moment in the market is unique. There is no market like no other, regardless of the time, the circumstance, or the currency pair. Everything is different for every time you trade it, and you need to accept that, right? Now, which trader would you rather be? Trader C, trader B, trader A, or smarter trader C? A lot of people would say I want to be smarter trader C, right? But a lot of people aren't really practicing what they're preaching. They're just speaking it for the fun of it, right? They're just speaking because, yeah, I want to lose less money and make more money. But it takes discipline. It takes knowledge. Now you know this. Now I want you to implement it. And I hope you're writing this down somewhere so that at a later stage you can, right? You can review and learn more about it. Moving on, we want to speak about one of the things that is very overlooked, diversification, where it's the holy grail. Literally, if you're looking for the holy grail, this is your holy grail, right? Especially if you use the BMF profit manipulator, you already know that I've already integrated this within the algorithm. That's why we have such a high win rate strategy. But let's move on. Now, what is diversification? So diversification is a risk management strategy that involves spreading the investment across different assets or asset classes to reduce the overall risk of a portfolio. Now, the goal of diversification is to avoid putting all your eggs into one basket, right? Thereby minimizing the impact of poor performance in any one investment on the overall portfolio. Now, diversification is based on the idea that different assets may react differently or perform differently to the same economic events or market conditions. Now, you need to diversify your portfolio. You cannot put your eggs into one basket. You cannot only trade major currency pairs. You need to trade cross currency pairs. Now, that's diversifying. Even when the major pairs aren't performing as well, the cross currency pairs, excuse me, could be performing quite very well. Now, who is the guy on the right? So this guy is one of the guys that I really look up to. His name is Ray Dalio. Now, if you don't know Ray Dalio, he is a hedge fund manager, a founder of Bridgewater, which is a hedge fund company, and he's one of the wealthiest people in the world. I think his net worth is around about $15 billion. Now, he manages a hedge fund, so he speaks about diversification and how that helps. Now, we're going to watch that video in a second. Now, let's just jump onto the video and listen to what the smart mind has to say about diversification.
The question for me was, what were the marginal benefits of diversification like? What is that going to look like? Okay. And what I then decided to do was to think about risk and the number of sample size and the correlation of the bets, broke it down to each of its components, right? So, to use an example, let's assume you have, to make it simple, a return, something that has a 10% risk. We'll call risk standard deviation. And let's make it simple, and let's say it had a 10% return. And let's say I add in another asset, another return asset, return stream. I add in a second, a third, a fourth, a fifth, up to whatever number. How would that reduce my risk if it on average has a 60% correlation, or if it has on average has a 40% correlation, or a 0% correlation? How would that change? Wanted to know that, right? So that's what this chart shows, right? And so so imagine you have a 10% average return. You don't know which bet is going to be better. Has a 10% average return and a 10% risk, and you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe is about 15%, and you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows, okay? And it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic is in you only need to do this simple thing. The simple thing is to find 15 or 20 good uncorrelated return streams, things that are probably going to make money, but you don't know, but they have a good probability of making money, and but you have that are uncorrelated, that have low correlation. That told me that's what I have to go after, right? That's the key. A lot of people think that the most important thing you can do is find the best investments. Okay? That's important, okay? But there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5, right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably, nobody's humanly capable in an efficient market probably to pick investments that are 5 times as good individually, but so that path. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. You know, like if I can get 0 correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%, okay, as distinct from 40% with any one of those. So that's the power of portfolio construction and the power of diversification, okay? So it tells me what I have to go after.
Okay, now you're most probably watching the video and wondering, I don't understand. It also took me some time to understand, right? It also took me some really deep understanding to understand what this guy was speaking about. But essentially, he's speaking more of how to diversify and the power of diversification, as the more you diversify your trading portfolio, it doesn't maximizes your returns, right? But it lowers your risk, right? That's the power of it. It minimizes your chances of losing way too much money. But let's move on to understand it in terms of examples. Now, how do I diversify in Forex? Now, there's currency pair diversification, right? You can mix, like I've said in the beginning, you can trade major currency pairs which have the dollar in it. You can trade minor currency pairs which don't have the dollar in it, for example, Euro GBP, or you can trade exotic currency pairs like USD SGD, which is the dollar versus the Singapore dollar. You can trade those things to diversify, meaning that if major pairs aren't performing, minor pairs may be performing, or exotic pairs may be performing. So you need to diversify your portfolio. You don't need to put all your eggs into just the Euro USD or the GBP USD. You need to explore the currencies too. That's what my students always tell you. We trade currency pairs that are cross currency pairs, for example, GBP JPY, right? One of the most volatile and most fast moving. You can hit this week. We hit, I think, around about 130, 126, I think, or 130 pips in one trade in one day, right? That's the power of those things. So geographic diversification, you need to trade currency pairs from different countries, right? You don't need to only trade the dollar. You can trade the euro. You can trade the ZAR, which is under speculation for manipulation, right? It's another story for another day. But you need to diversify in time frame. Trade the hourly, the daily, the minutes, right? You can even go to the seconds if you want to, right? Because the 1 minute could be going up while the 4 hour is in a downtrend. You need to diversify your portfolio, right? Strategy diversification. You need to use different strategies, right? For example, the BMF profit manipulator um, can trade in uptrending markets, downtrending market, or just basically trading markets, or it can trade in, for example, what you call this ranging markets. That's the power of the system. It can weather every market. That's why I say that I've tested it with 5 years of back testing, right? I went way back to 2018 and I tested it till this day and it's still profitable. Like the video that I sent out, it's still profitable. It's still, it shows positive returns. Now I didn't just test it for a week or use back testing for just from today till last. No, I used it for the past 5 years. It performs better even during the pandemic, right? Risk management, that's one way to diversify. Learn to implement effective risk management techniques such as stop losses and position sizing. Correlation analysis, that's another thing that we want to speak about, right? Be aware of the correlation between currency pairs. Asset location, you do not need to only trade Forex. You can trade gold, you can trade Nasdaq, you can trade the US 30, the German 30, you can trade different commodities and indices and indexes. It doesn't need to be one thing because the Forex market might not be performing, but the commodities market might be performing. Gold might be skyrocketing, right, while the dollar is falling. It might be skyrocket. So you need to put these things into your eyesight, right? Into your peripheral visions. You need to look at all these things. So that's why I said this is part where it's more for advanced traders, people who are more, they understand the basics of trading. Because now we're speaking of languages a lot of people don't know. A lot of people don't know what currency correlation is. Positive coefficients and negative coefficients. They know how to buy and sell. They know the NFP, the CPI. They know those things, but they don't know the things that are true to the game of trading. And if you're watching this video, you are part of the people who are striving to become better because you are out there giving yourself the time to learn new information for the better of your own good, right? And that's very important. Moving on, you need to stay informed. Like I said, geopolitical events. You need to all know, like have a Bloomberg app or Wall Street journal subscription or news letter or whatever it is for you. Avoid over leveraging. Avoid using too much leverage, like 1:2000. That is not necessary. I promise you. That thing will blow your account more than you will grow it. So avoid those type of things. regularly view and adjust. Like I said, look at your trading plan. Look at how good is your trading performing, right? But if you're in the signals group, there's no need for that because we do that for you, right? So we move on to currency correlation in Forex. Now, what is correlation, right? So we have two types of correlations. We have positive coefficiency, right? We have positive coefficiency, and we have negative coefficiency. Now, what is positive coefficiency? Now, this refers to a positive correlation between two variables. Now, in this case, we are speaking about currencies. Now, a positive coefficiency indicates that the currency exchange rates of two currency pairs move in the same direction. Now, that is positive correlation. Positive coefficiency. Now, what is negative? Contrary to what I just said, negative coefficiency is when two currency pairs move in the opposite direction of each other. Now, if you're still lost, I'm going to explain it even further. Now, these are examples of positive coefficiencies, right? Now, this pair is the Euro USD. Now, if you look closely, right, I'm just going to throw it. If you look closely, this market is trending down. Now, remember what we're speaking about here is the Euro USD, right, in the monthly time frame. Now, Euro USD is going down. Now, since it's a positive coefficiency with the GBP USD, the GBP USD will also be going down. Remember what I said about positive coefficiency, right? Remember what I spoke about when we spoke about positive coefficiency. It refers to currencies that move in the same, this is very important, same direction means positive. They are going in the same direction, right? Now the Euro USD is going down. What does that mean for you? The GBP USD will also be going down. You see, a lot of people don't know these things, right? They don't know the positive coefficiencies and the negative coefficiencies, but they know how to buy and trade. They know how to buy and sell, excuse me. They have MetaTrader apps on their phone. They have trading view. They have all these things, but they don't know the importance of understanding the game of trading. What I always say, two important questions you should always ask yourself as a trader is what and why. What is positive coefficiency? Why is USD and Euro USD moving in the same direction? Right there, you'll get your answer. Right? I'm giving you guys jewels that a lot of people don't know about. A lot of people aren't teaching out here. They're just teaching people how to plot um, trend lines and all those type of things, like the market moves with your trend lines. But that's a story for another day. Now, these are the currency pairs side by side. Now, these are the positive. So, like I said, if one goes down, since they are positively correlated, the other one will also go down. Now, what does it mean for you? If you have a sell order, if you have a sell order right here, right? You do not open another sell order right here. Why? Because these two move in the same direction. If you open a sell trade here and another sell trade here, the only thing is you will be exposing yourself to so much risk because you are risking two times. Because these two things move in the same direction. So God forbid the market goes up and you sold two of these currency pairs. It means that instead of losing one trade, you will lose two trades, meaning that you've maximized your risk. Now that's the importance of understanding positive coefficiencies. Now, negative coefficiency examples. Now, like I said, negative coefficiencies, they move in the two opposite directions. Now again, we're going to be using the Euro USD, the Euro dollar, in the 1 month time frame. Now, if you look closely, the market is going down. Now, when it comes to negative, right, they move in opposite directions. For example, let's take for example, you and your partner are having a disagreement. Now, he says that I want to go to park A, right? And you say you want to go to park B. You guys have negative thoughts. You have negative things, or you have negative ideas of where one wants to be. Exactly the same thing for negative coefficiency, right? If the other one goes down, the other one will go up. This is an example of the US dollar versus the Japanese yen. It is negatively correlated to the euro dollar, meaning that when the euro dollar goes down, this goes up. You understand that, right? So you do not put um, trades that are opposing in. You can't put a buy here, right, and a sell here, right? Why? You most probably asking why. Again, you will be exposing yourself to risk, because if they both go into the opposite direction, you will lose your money. So try and know this information. Jot it down somewhere. Know this information. You should know to separate between negative coefficiency and positive coefficiency. Now, these are the pairs side by side. These are the negative coefficiency, right? The negative coefficiency. Now, if this one goes down, right, the other one will go up. Now, these are negative correlated currencies. Now, why is this important? Diversification, right? Avoiding unwanted risk, right? You don't want to expose yourself to so much risk. And another thing is hedging the market. Now, what is hedging the market? That's the sole purpose, or one of the most important characteristics of why we have something called a hedge fund. So hedging is minimizing the loss without maximizing profit. Right? Now I'm gonna show you a real world example in Forex. Okay, so let's take for example you have a let's just say a buy order right here, right? And your stop loss is maybe 30 pips, right? Let me just put it just at 30 pips, and again, just for example's sake. Now, let's say for instance, you put your trade in here, right? Right now you are in the negative, right? And you are about to lose. Let's say for example, let's say for example, let me just look for. Let's say for example, if you lose this trade, you will lose 10 USD, right? Now, to minimize the loss, since you already know that this market is trending down, what you'll do is you'll go to GBP USD. Now remember, GBP USD and Euro USD go in the same direction, right? So since this is not going in your buy trade direction, you will go into here and you will open a sell order, right? Sell order right here. Now you entered earlier this side. Now that you're losing, you just entered a new trade, right? That's why I put it here, right? Now, if the market continues to go down, this will continue losing, right? But this will be gaining. Now that is where hedging is important. That's why diversifying your portfolio is important. You are minimizing the risk without maximizing the profits, right? You are trying to like shorten your losses to a small amount as possible. Now, if this goes down, for example, I'm just gonna make it for argument's sake. It goes down, and let me just remove this quickly. But where do I do this now? I don't want to use. Okay, so I don't want to use nothing, chief. So now this goes down, for example, let's say it goes down and the market just where's this, it just continues to go down, and you hit stop loss and you lose your $10, right? Whilst you lost $10 on this trade, you might have gained, maybe let's say for instance, $4, right? You might have gained $4. Now, if you take the $10 you lost minus the $4, so in total you've lost only $6 instead of the initial 10. See, that's where you become a very profitable trader. These are things that a lot of people on practicing for themselves. Now you can rewatch this video time and time again and look at the jewels or the things that I'm sharing, which can help you to become a very, very good and profitable trader. So you don't need to necessarily lose every time. Because even when you're losing, you can mitigate your losses with hedging your positions, which minimizes your losses without maximizing your profits. So instead of $10, you would have only lost $6, right? Since you sold after seeing that this trade is not going to your direction, so you sold. So if this continues selling and it hits a stop loss, this will gain $4, offsetting the $10 loss, which says 10 minus 4, which you are left with 6. Now you've only lost $6. That's what hedge funds do. That's what Ray Dalio was speaking about. If one asset is not performing, you hedge it with another one or diversify your portfolio to minimize your risk. That is the holy grail. Now we have reached the end of our video. Now you can go over this video time and time again. I'm just going to reiterate what we've spoken about. Excuse me. Now, in conclusion, we spoke about mastering the risk management strategies, right, and understanding that this is a cornerstone for success in the dynamic world of forex trading. And this video has delved into the advanced strategies tailored for seasoned traders, right? We've explored the fundamentals of risk management, emphasizing the key principles like position sizing, stop loss orders, and risk to reward ratios. Now, by understanding these foundational concepts, you are better equipped to navigate the intricacies of the market. We've also journeyed through the advanced position sizing techniques, discovering how optimal and adaptive stop losses strategies can elevate your risk. Now management game, recognizing the importance of portfolio diversification. This is where we explored how different trading across different currency pairs and employing varied strategies contributes to a resilient and robust portfolio. Now, to solidify your understanding, we also tapped into practical case studies where I showed you examples showcasing the tangible impact of effective risk management in diverse market scenarios. Now, as you embark on implementing these strategies in your trading journey, remember that adaptability and continuous learning is the key. Now, in the upcoming videos, we'll unravel more advanced topics, which will better equip you with understanding the knowledge and skills needed to thrive in the forex market. So, stay tuned, stay disciplined, and may your trading journey be prosperous and well managed. This is Letum Tembu, the founder and mentor at Blue Million Forex. I'll see you guys on the other side.